Kevin Allading here. It's a really nice summer evening here in Indianapolis. It's July 2024. If you've seen my videos before, you know that I'm an estate planning lawyer. What you might not know is that I do most of my work through an investment advisory firm, and that firm does a lot of work with alternative investments. That term, alternative investments, is not very well defined, and to me, it means anything other than publicly traded stocks or bonds or derivatives of publicly traded stocks and bonds like mutual funds and ETFs. So they might include things like private equity, real estate funds, real assets, hedge funds, volatility managers, absolute return funds. All of these are examples of alternative investments. So should you have any? Should you be invested in alternatives? You might want to. If you're worried about the direction of the stock market for whatever reason, you're just worried that it's not going to perform well, maybe it's going to go negative, then why would you put a lot of money in there? It's kind of nice to have some other place to put your money. I remember in 2008 and 9, I was full-time practicing law, and a lot of my clients had money with advisors. Well, almost all my clients had money with investment advisors. And the advisors only offered two options: publicly traded stocks, publicly traded bonds, and both were down. And so, for a couple of years, these guys just had to suffer through it because they had no other options available to them. We're looking for investments that are influenced by different factors. If you have a diversified portfolio of stocks and bonds and the stock market goes down, then your diversified portfolio is going to go down. And if the stock market goes up, then your diversified portfolio is going to go up. But that doesn't mean that your real estate fund or your volatility fund or your private equity fund is going to act the same way, because it's influenced by different factors. That's the idea. So why are you not already in alternatives? Probably because you don't have access to it. Why don't you have access to it? Because it's hard to get access to it unless you find a professional advisor who spends a lot of time in this world. If you work with one of the big box stores, you're probably not going to get access to alternatives because they just don't have a lot to offer, and they really don't allow their advisors to go outside this very narrow range of the investments that they offer. So good luck with that. So you're really going to have to go to a registered investment advisor, and even there you're going to find that not very many of them invest in the alternatives market. And the reason is because it's a completely different skill set to understand if you should be investing in this particular real estate fund or putting money in a volatility manager, and if so, how much in each. And there are things you have to worry about, like liquidity and capital calls and lockup periods and gates. And so it's a completely different skill set. Investing in alternatives is a different skill set as compared to investing in the publicly traded stock and bond markets. So a lot of people don't do it because it's hard. Here are 4 reasons why you, as an individual investor, might not want to invest in alternatives. All right. Again, I told you that before. I like the idea if there's some good reasons to invest in alternatives. But before you dip your toe into this, understand these 4 things. First is regulation. Alternative investments are less well regulated than the public stock and bond market. So if you want to learn about Eli Lilly or Amazon, you can look at their SEC filings and you can look at the news media. There's tons of reports out there about those companies, about all publicly traded companies. You shouldn't have any trouble learning about those companies. Not so with the alternative investments. The information is simply not available to the same extent, anywhere close to the same extent as it is with publicly traded companies. So one of the reasons that investing in alternatives is difficult is because you have to put a lot of effort into understanding them. Second reason why you might not want to invest in alternatives is because it complicates your taxes. If you're used to having an easy tax return, a W-2, and then a 1099 from your investments, and then you can file your tax return online through TurboTax every year on time, then investing in alternatives is probably going to change that. Most alternatives are set up as limited liability companies or limited partnerships, and so you'll get a Schedule K1 instead of a 1099, and you'll probably get it late. So you're probably going to have to extend your tax return, and you're going to have to deal with a tax reporting form that you're maybe not used to. Now, if you already have a complicated tax return, then don't worry about it. It's no big deal. It's just more complication on top of the existing complication. But if you're used to this and if it's going to frustrate you, then you might think twice. Liquidity is a big deal. If you're used to investing in stocks and bonds, you can call your broker, or you can push a button on your computer and your stock can be converted to cash that will be available to you within 3 days or so. Not so with alternatives. In fact, a liquid alternative means that you can probably get your money in a month, but those are pretty rare. Usually it's more like a quarter or 2 quarters. So an alternative with some liquidity might mean that within, 6 months or maybe 4, 5, 6 months, you can get your money out. More often, there are lockup periods. So once you put your money in, you got to commit to keeping it in for a year or 2 years or longer before you can withdraw it. Now, that doesn't necessarily mean that you don't get any return on your money. The money's being invested and you can get the distributions, the earnings on the money, and maybe even some return of capital. But if you just want to cash it out, it might be a little bit difficult. So think about the liquidity feature before you put a lot of money in alternatives. The tax character of your investment is also important. If you have money in stocks and bonds, then most of your returns probably come in the form of qualified dividends, taxed usually at up to 20%, or long-term capital gains, also taxed at up to 20%. With alternative investments, you're going to find a greater share taxed at ordinary income tax rates. Those are up to about 36, 37%, and also capital gain rates. So you have to take all these things into consideration. There are some advantages. You get that mega diversification, you get some other options, but there are some disadvantages too. If you have specific questions or some comments or ideas, put them down there in the comments.